What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be dropping another series in our KreativeU playlist. And what we're going to be talking about today is the Fed meeting. We're going to be talking about CPI. We're going to be talking about earnings. And we're going to be doing this on a case study analysis, right? Here at Kreative Kodr, our aim is to be able to create different algo trading videos, being able to break down AI agents, right? And being able to understand what machine learning is and how we can use that in different coding projects. So today, this KreativeU episode is breaking down these different, I think, it can be some of the most important information that you can use when it comes to trading, but most traders like tend to overlook it. And I want us to be able to spend a little bit more time on how this information works and how we can use it. So let's go ahead and jump in. So the foundation, right? Being able to know the catalyst. The Fed or the Federal Reserves, the Fed controls the interest rates. The interest rate is just another way of saying the price of money. When interest rates are high, we're looking at borrowing costs increasing, right? Companies are going to be a little bit more stagnant when it comes to growing. Why? Because most companies grow on borrowed money. And if the borrowed money is high, if it costs high to be able to repay that debt, you're looking at them being a little bit more stagnant when it comes to growing, right? And when their company's not growing, guess what's going to happen? The stock price is going to drop, right? So we're entering a, you can say, and it's not always that correlation, but some can say when interest rates are high, we tend to be in a bearish market, right? Because prices are going down, companies are not growing, and cost of borrowing are a little bit more exorbitant. Now, when we are in a low interest rates environment, guess what happens? There's cheap money. So if money is cheap, guess what a company can do? A company can go ahead and expand. A company could go ahead and put more money in R&D. A company can put more money in a different feature or a new development or a new area within that they want to be able to expand in, right? And then you're going to see stock prices being able to reflect that because the company being able to reinvest in themselves, and the stock price or the market is going to thank them for that, right? So FOMC or FMOC meetings are 8 times per year, and they are announced the rate decision, right? And we just had one occur today, January 18th, 2026, whenever you're watching this. And that's why I wanted to drop this video to coincide with that, so we can be able to understand what this data means. And we're going to go over what the chair decided to do, Chairman Powell, that is, or FMOC, the committee, because remember, it's the committee that meets and to be able to announce their interest rate decision. So it's not on Chair Powell, even though that, yes, he is the face of the committee. And just jump over to, and I know I'm going to be bouncing back and forth, but so you all can see this. And don't worry, we're going to be breaking this down in our code as well. So when I say Chair Powell, that's the board of governors, right? So that's the chair of the committee, and there are 10 members within the committee, and these are all the members right here, based on 2026. And as you can see, it was just updated today, right? And all these members are appointed by the president, right? So let's go ahead and keep going. So CPI, or Consumer Price Index, is the CPI measures inflation. So how fast is the prices are rising? When CPI is high, we have prices are rising too fast, and the Fed may raise rates, and they're bearish, right? So CPI is the Consumer Price Index. So for lack of better words, it is the thermometer, right? If one can say that, it is the thermometer of the market. So what we're trying to understand, or the temperature, excuse me, the temperature of the market, right? So what we're trying to understand is, okay, if CPI is high, then we know that prices are raising way too fast, and the Fed may cut the rates, and they're a little bit more bearish because they want the prices to be a little bit more cool, right? And when CPI is low, we have cool CPI, prices are a little bit more stable, and Feds may cut rates, and they're bullish on the market. Bearish meaning that they're thinking that the market is going to go down, right? Bullish meaning thinking that the market is going to go up. Now, CPI is released monthly, usually the second week at 8:30 EST. So we're a little bit behind. But don't worry, we're going to be reviewing the CPI information in just a bit here for January 2026, whenever you're watching this, so we can be able to get context of how that data looks and how we can apply that to strategies that we have. And then we have earnings. Earnings are going to be the quarterly reports where companies reveal their profits, revenue, and guidance, right? So when they beat expectations, we're going to have these stock jumps usually. And the reason we have usually here, right? So just because our company beats expectation doesn't always mean that we're going to have that stock actually or the market being able to award them for that. Sometimes it's flat. Sometimes you're going to have the stock drop, right? So just because a company beats expectations or being able, what is expectations, right? So there's going to be some analyst that's going to say, all right, I think XYZ company is going to make, and this is just a very simplified version of it, right? And we're definitely going to look at a few earnings reports and being able to understand how that works. But just to be able to just to keep going with this caveat, right? So analyst XYZ says that company ABC is going to make 300,000 in profits, and out of those 300,000 in profits, they're going to make $1 billion in revenue, right? And their guidance is to be able to make sure that they want to consistently grow while keeping costs low. Something as simple as that, right? So if the company, when they're dropping their earnings, if they beat the expectations, usually what happens is that the market will reward them and you'll see a little jump in the stock, right? But if the stump company misses their expectations, the market will kind of penalize them, if you would, and you'll usually see a drop in the stock. Now, the reason I have usual here, because again, that's not always the case. But the micro context matters, right? Great earnings can still fall on bad Fed news. And we're going to go over what the Fed decided to do today. So this is all going to coincide with our events. So the core principles is that these three events create volatility. When they overlap, risk multiplies. Smart traders know when to engage and when to sit out. So this is going to be our core curriculum breakdown, a module one. And again, this is going to be a case study type of breakdown where we're going to be looking at past data, what happened, why did it happen, and how can we use that to be able to further educate our future decisions, right? So module one is going to be based off of the timing basics. Module two is going to be based off the danger zones. And then module three, we're going to be based off clean setups and patterns. And we have 6 case studies to go through, about 1 to 3 minutes each. So not too long. So if you haven't already, please make sure that you like and subscribe. If you like this, that means somebody else may like this as well. So what you're going to learn is how to read the calendar like a pro, or just as much as a pro. So I consider myself an amateur, right? So just because I'm the one behind the mic doesn't mean I'm not a pro yet. Like I'm a little baby amateur becoming a pro, right? Spot dangerous event clusters and being able to apply repeatable decision frameworks, and understanding that there's patterns in this too, that others may miss. So here is CPI, and again, CPI is the temperature of the market, temperature of what's going on, right? So CPI from January 2023 to July to January. So we're taking about just about every 6 months, right? So we have CPI 6.3. We're seeing that that is extremely high, right? So prices were raising a lot higher. We were in interest rate cut environment. So as you can see here, how it coincides with the federal fund rate, right? In January 2023, CPI was high. You also had the federal fund rate increasing a bit. So you see how it coincides, right? So when CPI is high, when it's in the red, Feds may hike the interest rates and we're going to have the stock market fall. So let's look at another example. July of 23, we had CPI going down. So just about 6 months later, CPI started to head down in the right direction, right? And then July of 23, we had the Fed increase rates, right? CPI is falling. Fed decided to pause, stock market rally. Or when CPI is green, Fed may cut, stock market rallies, right? So key insights here is that the CPI releases, market predicts the Fed, price moves before the Fed can react. So the Fed just reacted just about an hour, almost 2 hours ago. It's about 3:47 p.m. Eastern. The Fed drops their decision on 2 p.m. Eastern after their second day meeting. They meet for 2 days on the 27th and the 28th. It's not always on the 27th and 28th. It just so happens to be that this particular meeting was on January 27th yesterday and the 28th today of 2026. And they released their meetings, their meeting statements, or their decision, excuse me, at 2 p.m. right? And we're going to get to what happened, what their decision was. but I want us to be able to understand how the data coincides here, right? So let's go over this one more time. If we have CPI high, what may happen is that the Fed may decide to hike interest rate, meaning they want to increase interest rate. If they increase interest rates, that means that borrowing capital is more. If it costs a company more money to borrow capital, right, they're not going to be able to expand as much. They're not going to be able to invest in R&D. They're not going to be able to probably M&As or any other acquisitions, right, because the borrowing of that capital is high. Excuse me. So then you're going to see, not all the times, but you usually see stocks will fall, right? And then when we have CPI falling, Fed may pause. So if the Fed is not going to charge more to borrow money, the stock may stabilize and even some instances rally, right? You may get a little micro rally, little baby bull rally there when the Fed decides to pause. And what they wanted to happen, and I kind of agree for what they did decide to do, is just pause, because I think we'll get to that point before I give my opinion. CPI was low. The Fed may cut. If the Fed is cutting, that means it costs less to be able to borrow money. If money is cheap, then a company will be able to expand. If a company is expanding, what's going to happen is that the stock market will rally. So the market will thank them for being able to rally. Not always the case, but a good majority of the time, you're going to see the market being able to rally, right? Key insights is being able to understand this pattern right here. All right, so let's go ahead and go to the next portion of this. So what is the Fed, right? The Fed is the Federal Reserve. The Fed is the central bank of the United States. Their main job is to keep prices stable, to control inflation. So whenever you hear that word inflation, you want to be able to keep inflation prices, right? So their job is to be able to control inflation or keep price stable and keep people employed, support the job market, right? How do they do that? By raising or lowering interest rates. When interest rates are high, it costs more to borrow money. People will spend less, and then inflation cools, right? So that's one way that they could combat against inflation, right, is to being able to raise interest rates. But there's almost that catch-22. It's like, yeah, I hear you that you're trying to combat inflation, but it's going to cost me or a company more money to be able to borrow money. So if it costs more money to borrow, right, then that means that ideally I'm not going to spend more, right? If I'm not spending more, then what you're trying to do is being able to slow down inflation. You want to be able to slow down how much it costs for everyday items, right? So that's what happens when you have a Fed trying to raise interest rates. When they want to lower interest rates, right, borrowing is cheap. So if borrowing is cheap, guess what people are going to do? They're definitely going to spend more money because it's cheaper to be able to borrow money, right? And the economy is going to grow. Why is the economy growing? Because people are putting money into the economy, right? So ideally, when you're hearing that, all right, I want to be able to cut interest rates, is because you want to stimulate the economy. You want to be able to get the economy booming. You want to get the economy working and moving, right? So I know after COVID, in COVID, right, and I want to use that as an example because everybody could be able to relate. Not everybody, but most people could be able to relate to that, right? So when I say COVID, we were in an environment where shit was expensive, right? So what was happening is that the Fed was increasing interest rates. What they wanted to do is they wanted to cool inflation, right? They wanted to tell people, hey, bro, you're spending too much money, right? We want to be able to cool inflation, and the way that they wanted to cool inflation is to raise interest rates, right? Because they control the monetary policy. Right now, after COVID, they want to be able to stimulate the economy. How do they stimulate the economy? They drop interest rates, right? It's easier to be able to borrow money. People are spending more and they're stimulating the economy. Why traders care is because the Feds raise interest rates, stock often drops, especially growth in tech stocks, right? When the Fed cuts interest rates, stocks often rise. And the reason we have this word often is because it's a causation, not a correlation type of thing, right? Sometimes the cut can cause the drop, but it's not always correlated to it. Sometimes the raise can cause the drop, but it's not always correlated to it. Sometimes the cut can often have a rally, but it's not always correlated to it, right? So we understand the Fed. Beautiful. Now I want you to keep this in play, because remember, we're going to have our little quizzes at the end of this, just to be able to make sure we're checking for understanding. All right, FOMC, or the FOMC, or I just call it FOMC, is the Federal Open Market Committee. The FMOC is a group within the Fed that actually votes on the interest rates, right? Who, excuse me, who's on the FMOC? There's 12 voting members, 7 members of the Board of Governors appointed by the president, and the president of the New York Fed, who always votes. And there's 4 rotating Reserve Bank presidents, and they rotate each year. So how often do they meet? They meet about 8 times a year, so roughly about 6 times a every 6 weeks, excuse me. Each meeting is 2 days, and the decision comes out on the second day. So the decision came out today. They met on the 27th, which was yesterday, and then today, and then they dropped their decision today, which we're going to go over, right? And being able to understand how is that going to impact our trading decisions moving forward. So what happens at these meetings? They review economic data. What they're looking at is job reports, right? Job reports come out every week, right? So job reports come out, right? So how many people are employed? How many people are actively looking for work, right? So this is the data that they're looking for. They're also looking at inflation, how expensive it is to be able to purchase something, right? And they're also looking at GDP, which is gross domestic product, excuse me. So what they discuss is the risk and outlook, right? All right. If we decide to cut interest rates, right? If we want to be able to stimulate the economy, what is going to be the impact of that? So all these members get together, right? Remember, these are the members, right? I know we talked about it before, but now we're actually getting to the weeds of it. So these are the 12 members, excuse me, of the Fed, or the FOMC, right? The, excuse me, the Federal Open Market Committee, FOMC, right? All right, beautiful. So what was I saying? Yeah. So they want to discuss, okay, if we're thinking about stimulating the economy, we want to cut interest rates, right? What is going to be the impact of the cost of borrowing, right? Are people just going to be running to the bank to be able to get every single loan, right? So they're looking at the risk, and they're also looking at the outlook. They vote on the interest rates, and they release a statement explaining their decision. And then the chair, which is Chair Powell, holds a press conference 30 minutes after the statement. So the statement drops at 2:30, from about 2:30 to 3:30, sometimes 4, depending on how busy it is or how crazy the market has been, right? Or depending on what they do, right? It's depending on how long that they're going to be answering questions. So key insight is that the vote split matters more if it's a unanimous vote, meaning that all 12 individuals decide to be able to hold the line, right? Pause and not cut. If they decide to cut, or if they decide to raise, if it's unanimous, there's strong consensus, right? But if it's a split vote, there's a disagreement. That also lets us know that there's a potential policy shift coming, right? So who is on the FOMC? The voting members are the Board of Governors, who always vote. We have Jerome Powell, John Williams, Michael Barr, Michelle Bowman, Lisa Cook, Philip Jefferson, Stephen Myron, and then Christopher Waller. And then rotating regional bank presidents, we have Beth Hammock, Neil Kaskari, Lori Logan, look at that, Anna Paulson. Why the names matters, because we want to watch for hawkish members, and these are individuals that want higher interest rates. If you want higher interest rates, what do you want to do? You want to be able to cool down the economy, and what higher interest rates mean is that the cost of borrowing is higher, right? So whenever you hear somebody is hawkish, they want higher interest. Where are hawks normally? I mean, that doesn't make sense because doves fly up there too, so never mind. I can't use that little analogy. So hawks want higher interest rates. They want to be able to cool down the economy. They want people to stop borrowing, and they want things to be able to go back to a little homeostasis, right? Dovish members are individuals that want to stimulate the economy, right? They want lower interest rates. They want individuals to be able to borrow money, right? Watch their speeches between meetings and move the markets too, right? So these different members would sometimes go on CSNBC, Squawk Bog, right? Sometimes they're going to go to like these different, go talk to Kramer, right? For individuals to be able to give their outlook. The dude from Atlanta, I don't be saying a lot, but let's see. Yes, him, Ralph Boask. But let's keep going. So again, we did have a meeting today. We're going to be talking about it. The meeting was from the 27th to the 28th. That's wrong. I apologize. Little error on my end. And we're going to be talking about the statements. And the next meeting is going to be March 18th and 19th. So FMOC playbook. So what happens? We already talked about it. They drop their statement, then they have the press conference, and the press conference is usually an hour. Sometimes it could go 90 minutes, but it's usually about an hour. So what happens? Excuse me, I don't want to cough in your ear. Did they raise? Did they cut? Or did they hold? Right? Hold. Yeah, that's what they're trying to figure it out. I remember of that like Game of Thrones line. It was like, hold it. Okay, let me keep going. Was it expected? Right? And we're going to watch the statement language, right? The key phrases to watch is inflation remains elevated. This is a hawkish statement. Remember, hawkish individuals are people that want to be able to do what? Bump up the market, bump up the cost, bump up the volume. Bearish for stocks, right? Reason being so is because if it's more expensive to borrow money, companies are not going to expand as much. If companies are not going to expand as much, then we're going to see the stock drop a bit. So if the stock drops a bit, then we're in a bearish environment, right? Inflation has eased. If inflation has eased, that is a dovish statement. People that are dovish are individuals that want to cut rates, right? So these are people that want to be able to stimulate the economy. They want to get money flowing, right? These are bullish for stocks. Why? Right? Let's break it down. If they want to cut interest rates, they want to stimulate the economy. If you want to stimulate the economy, that means the cost of borrowing money is a lot lower. If the cost of borrowing money is a lot lower, that means a company is able to expand. If the company is able to expand, that means the market may reward them. If the market rewards them, that means the price goes up. If the price goes up, that means I'm bullish. So you see how we did that? Beautiful. Data dependent. You hear that a lot, right? They're uncertain. They're watching closely. So just be that. You may hear this again. They're a little data dependent. So the vote split, unanimous equals strong conviction. A split vote equals we're going to watch for disinterest wanted. So Powell press conference, often more important than the actual statement. One word can swing the market 1 to 2%. Pro tip, the biggest moves often happen during the press conference. We're a little bit at the tail end of it. Now, when the statement drops, stay alert for 90 minutes after 2 p.m. So here's what happened. If you actually want to go look at the statement and for us to be able to actually read it, I'm going to do my best here. This statement was dropped today at 2 p.m. Let's just zoom in so you can make sure you can actually see that. So this was, if you want to actually get the statement, right, all you have to do is you're going to come to the FMOC. And don't worry, I'll drop this link here so you can actually get it. You don't need to see that. My fault. Then we're going to come to meeting, calendars, and information. Then today's statement, the 27th and the 28th bet. Then we're going to pull the PDF version, and it's going to populate here. All right. So let's see if we can catch any of these dovish, hawkish, or let's just see if we catch any dovish or hawkish statements, right? So the available indicators suggest that the economic activity has been expanding at a solid pace. Job gains has remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. The committees. Okay, let's just go by this one by one because I don't want to fly through this. Now, remember, remains elevated. If it remains elevated, then what does that mean? That is a super hawkish statement. So if we're seeing hawkish statements, that these means that these are individuals that probably wanted to raise the interest rates. If you wanted to raise the interest rates, what does that mean for me? The cost of money probably is going to be a little bit higher, right? The cost of companies are not going to be able to expand as much. And if they're not going to be able to expand, the market is not going to reward them. And if the market is not going to reward them, then you're probably going to see the stock drop a bit, right? So somewhat elevated. That's interesting. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risk on both sides of the dual mandate. Dual mandate meaning I want maximum unemployment, so I want people working at all times, right? And I want inflation to be at a rate of 2% over the long run. So i.e., I want people working, right? And I want them to be able to I want them to be able to borrow money, not at high rates, right? Beautiful. That's their dual mandate. In support of the committee, decided to maintain the target range of the federal fund rate at 3.5 or 3.75, so 3.5 or 3.25. And considering maintain. What does maintain mean? We're just going to sit where we're at, right? We're going to pause. We're not going to do anything, right? And considering the extent and the timing of the additional adjustments of the target range for the federal fund rate, the committee was carefully assessing the incoming data and the evolving outlook and the balances of risk. This can mean so many different things, fam. So incoming data is CPI, consumer price index. Incoming data is unemployment. Incoming data is GDP. Incoming data is what is the market doing right now. So they're looking at this data, right? The evolving outlook, again, another packed statement that could mean so many different things. And the balance of risk, it could be geopolitical risk, it could be the risk of the underlying stock market, right? So this is one of these arbitrary statements that you kind of parse between and read between the lines, literally, fam. So the committee is strongly committed to supporting the maximum employment and returning inflation to its 2% objective, that dual mandate, and assessing the appropriate stance of the monetary policy, the cost of borrowing money, how expensive things are going to be. The committee will continue to monitor the implication of the incoming information for the economic outlook. The committee will be prepared to adjust at the stance of the monetary policy as appropriate if the risk emerge that could impede the attainment of the committee goals, that dual mandate, right? Being able to make sure people are always working and the cost of borrowing money isn't too high, maintaining that 2%. The committee's assessment will take into account a wide range of information, including reading of labor market conditions, so unemployment rate, the inflation pressures, CPI, and inflation expectations, what are the analysts or market thinks, and the financial and international developments, i.e. geopolitical risk, i.e. what is the stock market doing, not just the US stock market, but Asia stock market, Europe stock market, Canadian stock market, right? What are the other markets doing? Voting for the monetary policies were Chair Powell, John C. Williams, Vice Chair Michael S. Barr, Michelle W. Bowman, Lisa Cooks, Beth Hammock, Philip Jefferson, Neil Kashkari, Lori Logan, and Anna Paulson. Voting against actions were Stephen Moran and then Christopher Waller, who preferred to lower the target range for the federal fund rate by 0.25%. So they wanted to cut by a quarter. 1.25%, 1/4. At this meeting. For media inquiries, please contact them, or you can even call them too. And here's more about their decision. Right, the federal fund had made the following decision implemented on the monetary stance, announced by the FOMC, the Federal Open Market Committee, in the statement on January 28th, 2026. The board committee and the Federal Reserve will vote unanimously to maintain the interest rates on the reserve balance sheets at 3.65 effective January 29, 2026. As part of this policy decision, the Federal Open Market Committee voted to direct the open market desk at the Federal Reserve Bank of New York, until instructed otherwise, to execute the transactions in the system open market account in accordance to which of the following. All right, I'm holding interest rates. I need you to be able to maintain our rates right now, and overnight okay, and this is everything that they want to be able to do, right? So let's go back to what we're talking about, right? So we just talked about what the Fed is going to do. So they're going to hold, right? And we remember we talked about one of the things that's important is that, was this a unanimous decision? Was there a split? This was a split, fam. You had 10 members that voted yay, 2 members that voted nay, because they wanted to be able to cut. What they said is that inflation remains somewhat elevated. That is a super hawkish or dovish statement. So inflation remains elevated. That means that they want to cut. If you want to cut interest rates, guess what you want to do? If you want to cut inflation, you have to be able to raise interest rates. So this is a hawkish statement. The economy activity is expanding at a solid pace. This is somewhat of a dovish statement, because number one, we're talking about the economy is expanding at a solid pace. If the economy is expanding, you want a low interest rate environment. So this is a bit of a dovish statement. Uncertainty about the outlook remains elevated. Now, I can say that I can make an argument for this being hawkish, but I can also make an argument for this being dovish. But for the lack of simplicity, this is going to be a hawkish statement, right? The outlook remains elevated. Outlook being the inflation, right? If inflation is elevated, how do you cut inflation? By raising, interest rates. So Fed is cautious. We're holding rates steady. We're watching data before the next move. The next meeting is going to be March 18th, 19th. And I think I'm going to be starting doing this more just to react based off them, right? So what this means for traders, rates are held. So Fed is waiting, right? The market may be choppy until the next move is clear. So note there was 2 dissenters who wanted a cut. So some pressure building to ease policy. Until the next meeting, we're going to be looking at CPI. CPI drops, I think, the 13th, just before Valentine's, the 12th or the 13th of February. Hot CPI, that means Feds may stay tight. If Fed is going to stay tight, we're going to see the stock market drop, right? If we have a cool CPI, the Fed may cut. If the Fed is going to cut, then we're going to see a rally of the stock market. All right. So we talked about the FOMC meeting that happened today, right? The next CPI release is going to be the 12th. Excuse me. I thought I said the 13th, but it's the 12th. So it's about 15 days away whenever you're watching this video. So the current year-over-year CPI, we have it at cool, right? So the Fed may ease. Our 6-month average is 2.79 and 12-month average is 2.71. And our 3-month trend or quarterly trend, we're looking at CPI falling. Earnings, and remember, earnings is just a big old fat report card of how the company did. We have Microsoft, they're dropping earnings today, and then Tesla. So Meta, I would never call them Meta. Facebook is dropping earnings today, the 28th of January, and then Microsoft and then Tesla are dropping earnings today. So one thing to keep in mind, if you are trading them, right, you want to be able to make sure that you consider setting out or trade accordingly. But this is not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner, a financial advisor, or those that are licensed in order to assist you with this. All right, beautiful. So now that we see what's coming, these case studies below show exactly what happens around these events, right? We're going to watch for the patterns, apply them, and we're going to learn from the history so we don't repeat it, right? And what did they say? Those that don't learn from the history are doomed to repeat it. All right, bet. So our first case study is going to be NVIDIA's earnings before Fed week, right? We talked about the Fed. We talked about how it was worked. We talked about CPI, right? So we have a lot of context. So these are the terms that we're going to need to know. IV is implied volatility. This is going to be how expensive options are. High IV, we're going to have pricey options. Low IV, we're going to have more affordable and expensive options. The FOMC is the Federal Open Market Committee. This is the Fed meeting where the rates are decided. IV crush is when uncertainty ends. The IV drops fast and your option loses value even if you were right. And then hawkish, the Fed signals that they keep interest rates high or raise them. Bad for stock markets, right? So the situation back in January of 24, you wanted to trade NVIDIA earnings, right? And remember what earnings are. Earnings are just a report card for the company to be able to let us know how their profits are, how their revenues are, and any other guidance that they want to let us know. Everyone is super hyped because we have AI booming, right? So we were thinking that, all right, yeah, NVIDIA is the play back in January of 2024. But there's one problem, right? The Federal Reserve is meeting the same week as earnings. So if the Fed says that we're keeping rates high, they're super hawkish, the whole market may drop, right? May fall out his ass, right? Even if NVIDIA crushes your earnings, your trade still may lose. The question, do you trade before do you trade before the Fed talk or do you wait? So this is a visualization of the wallet and what happens when IV crush, right? So this is going to be our uncertainty tax, real numbers from January of 24. So option price was at $1,500. IV was 65. So as the Fed speaks, uncertainty evolves. So the IV went from 65 to 58 to 52. And you can see the option price was dropping too, right? So even if you are right, you're getting negative 35% just from IV crush alone. even if Nvidia moved in your direction, right? So that's why sometimes it's always best to be able to, all right, I want to trade earnings, right? I want to trade earnings for Nvidia. But wait, is the Fed meeting this week? Is CPI coming out this week? Right? You want to be able to make sure that you're as educated as an investor as possible, right? So that's why I'm sharing this information with y'all. So what happened is that CPI was at 3.4. We expected 3.2, so it's a little bit higher than we expected. So inflation came in hotter than expected. The Fed may stay tough or hawkish, right? And then on the 15th through the 16th, the FOMC meeting, the Fed held interest rates set higher for longer. That is a super hawkish statement, bruh. What that means is that that's bad for your underlying position, and that's kind of bad for borrowing as well, right? Higher for longer because they're trying to cool inflation, right? They're trying to cool CPI. CPI was a little bit elevated. If CPI is elevated, right, they expected 3.2. That shit came in at 3.4. Right, so CPI was definitely elevated, right? So the Fed said higher for longer because they're trying to cool CPI. They're trying to cool how much it costs us to be able to borrow money, right? How expensive it is in order to make everyday purchases. And then Nvidia dropped the 24th, right? 8 days after the Fed meeting, some breathing room, right? So the choice, do we, for options, do we trade before the Fed meeting? Fed could tank the market. You're guessing, depending on how you're trading. But hey, you're guessing. We're going to wait for the Fed, then decide. That's probably the better decision. Benefit, you know what the Fed said, less guessing. You're going to skip the trade entirely. Probably. Safe, but you might miss a good setup. So B is going to be our best choice, right? We want to wait for the Fed. Don't try to guess what they're going to say. Wait what they're going to say. Go actually read the statement, right? Once we actually read the statement and understand what they said, then we're going to decide. So the outcome, the FOMC hawkish hold, higher for longer. The market dropped 2.5%. The Nvidia beat estimates. The AI demand is strong, about a 16% pop. But the next day, profit taking plus Fed worry is a 3% pullback, right? Profit taking people are closing out the position. Be like, you know what? I just made my little 16% pop. Let me thank you very much. Let me go ahead and cash out. Right, and then we have Fed worry because higher for longer. Higher for longer means that's more expensive for me to be able to borrow capital. If it's more expensive to borrow capital, then what does that also mean? The company's not going to expand as much. If the company's not going to expand, then the market is not going to reward them, right? So that's why we had that 3% pullback. So the final report card is that if we traded before the Fed meeting, you're looking at a 2% drop. Or excuse me, 2% drop just from the Fed. You had 16% from the earnings. So it's like, yeah, you made your little cheese, but you had a 3% pullback as well. So overall, you made 11%, right? But if you would have waited, you had a 60% pop from earnings and a 3% pullback. So that delta is 2%. So that 2% more profit and less stress just by waiting, bruh. So it's just always good to be able to understand what the market is telling us. So when the Fed is about to speak, their words move everything, right? So Nvidia could cure cancer. The stock still drops if the Fed is hawkish, meaning that they want higher interest rates, higher for longer, right? We want to wait for clarity, then trade the earnings. So remember, Fed is greater than earnings always. Now, quiz time. We want to check for understanding, right? I just don't want to talk, so I want to check for understanding. Bet. So why was waiting for the FOMC meeting important? Nvidia always moves with the Fed. Shit me. The Fed stance affects the growth stock's valuation. The earnings don't matter during Fed week. Shitting me. This kind of almost told you the answer, bro. Explanation: the Fed stance on the rates directly impacts the growth stock market valuation. Higher rates equals lower percent values for future earnings. Let's go to question 2. What was the main risk of trading before the FOMC? We missed the earnings, not knowing if the Fed would be hawkish or dovish, or high implied volatility. I wouldn't be mad at that, right? But I think one of the main risks, we're not asking for one of the top risks, but one of the main risks of either of these. I wouldn't be mad if you said C, but one of the main risks is we're not knowing if it's going to be hawkish or dovish. So FOMC could be dovish, bullish for growth stocks, or hawkish, bearish, right? Trading before knowing is speculation, is not calculated risk. So what does higher for longer Fed commentary means for growth stocks, right? Is it bullish? More time to grow. Interesting. Is it bearish? Higher discount rates reduces valuation, excuse me. Or is it C, neutral, doesn't affect the damn thing? That's interesting. So it is going to be bearish. All right, so let's go to our next case study. Our next case study is going to be Tesla during CPI surprise. So the terms we need to know is going to be CPI. And remember, CPI is our consumer price index. This measures inflation, how fast prices rise. So this is going to be the temperature of inflation, right? So whenever you think of CPI, just think of the temperature, bet how high, how fast is the prices going up. Y over Y is going to be year over year. Comparing the month to month is the same, or M over M. MOM. When you see YOY is year over year. When you see MOM, it's month over month. DOD, day over day. You get it? Beautiful. Tailwind is something helping push a stock like good micro news. I don't know if you could call the Fed meeting micro news. I think it is the news for the day. And margins are going to be the profit margins, how much money the company kept from each dollar of sale. So January of 23. January. This thing is looking me right in my face. My fault, y'all. July of 2023. CPI came in lower than expected. Yo, that's shout out. That's a good thing. So CPI came in lower than expected. This is great news. Lower inflation. The Fed may stop raising interest rates and stock market may go up, right? The whole market is rallying. Everybody is feeling good. Tesla earnings are in 7 days, excuse me. You think easy money, right? But wait, the trap. Micro good news can make you overconfident. What if Tesla the numbers are actually a disappointment? That's why I really never trade earnings, bro. Well, let's keep going for those that do. So the risk is the tailwind doesn't equal a guarantee. Remember, a tailwind is going to be something that helps push a stock like micro good news, right? So real numbers from July of 23, the market reaction, SPY popped, and SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. SPY popped 2.4 points, right? Or 2.4%, right? That's 24 points. 2.4%, right? And you think Tesla earnings is going to be an easy 10%. So what we expect is that our position, for an example, was 10,000. Our position went up to 250, 500, so on and so forth, right? So we expect that 10% jump, but what actually happened is 2%. So you made money, but it was that 8% delta. The tailwind helped, but the weak margins killed the hype, right? And margins is how much the company kept from each dollar of sales. The profit margins is how much money the company kept from each dollar of sales. All right, so CPI came in at 3, but we're expecting 3.1. So inflation is cooling. Happy news for the market. The market decided to rally. SPY stayed up at 2.4%. Risk mood is on, right? Tesla's earnings is the 19th. And we think that the revenue beat, but the margins missed. So they made a lot more money, but their profits weren't all that, right? So FOMC came out after earnings. No fact. So FOMC after earnings, not a factor here. So the choice, are we going to buy immediately after CPI, the consumer price index? Risk is going to be the chasing the rally. We might be buying at the top, right? We might be buying at resistance levels. Are we going to wait 2 to 3 days to enter on the dip, enter on the pullback when it probably touches support levels? That's probably a little bit smarter. Benefit, a better entry price. The rally is confirmed. Or C, skip it, excuse me, don't trust the hype. So, but we may miss the potential gains, but could avoid the potential trap. So B is going to be the better choice, is because we're going to wait for a better entry on that pullback, and we have a confirmed rally. So the outcome is that CPI, the Tesla was up 3.5% on the market rally. 2 to 3 days consolidation gave back some of the 2%. Enter on the dip, a better price. The revenue, we beat revenue, but it missed the margins, right? So it made a lot of money, but it didn't keep too much money. So it's a mixed earnings. Results, it popped 6%, then it faded at 2. So as soon as it popped, like cash out. But all right, let's keep going. So the lesson is that a good micro news, right? A good tailwind, cool CPI sets the table, but earnings are the meal, right? So the market was in a good mood that helped Tesla not crash, but the margins were disappointment. The stock couldn't fly because it didn't keep too much money in order to either invest in R&D, in order to roll out a new product, right? Whatever it is, because it's Tesla, maybe drop out a new car, right? And let's just keep going. So the tailwind doesn't equal the guarantee. Micro helps, but the company still has to deliver. So why wait 2 to 3 days after CPI releases instead of buying immediately? CPI data might be revised. That can happen. Let the initial reaction volatility settle for a better entry. So our pullback, right? Or we're going to wait for the Fed meeting to comment on CPI. I think the best choice here is to be able to let the initial reaction of volatility settle, find our pullback entry, and then go ahead and jump in. What does cooler CPI mean for the market? Bad, deflation risk? Probably not. Good, the Fed may ease the monetary policy, so it's not as expensive to be able to borrow money. Or C, neutral, doesn't affect the stocks. Bruh, I wish. So it is ease. B, go ahead and ease it. Why did Tesla only gain 2% on good CPI and beating revenue? Margins missed overshadowed the revenue beat, right? Yeah, you can make a truckload of money, but if you're not keeping that money, if costs are exorbitant, right, and you're not keeping that money based off your profit margins, I don't give a damn how much money you're bringing in. But if you're not keeping that money, then it's like, all right, what's really going on? CPI affected wore off? Not really. Or the market was overbought? Probably, maybe. So I wouldn't be mad at that choice either. But it is A. All right, beautiful. So we have our next case study, and this is going to be Apple during a Fed pivot. So a Fed pivot is when the Fed signals a shift, like like stopping interest rate hikes. So they want to be able to maybe pause or cut. A binary event, an outcome of one or two things, good or bad, a coin flip energy. Whipsaw, A whipsaw is going to be the price swings up, then goes down fast. You get cut both ways, right? Because you have a volatile push up, but then you also have that crashing, consolidating back down. And then we have gap ups or gap down. The stop opens much higher or lower than yesterday's close. So the situation, let's go ahead and set the stage. November of 23. The situation was the Fed was meeting on Wednesday and Apple was reporting earnings on Thursday. 24 hours apart, gang. So both events can move the stock 5 to 10% on their own, but together it's like two earthquakes hitting the same building. The problem, if Apple goes up and it's the, is it the Fed or is it earnings? If it goes down, which one caused it? You can't tell and you can't hedge properly. So here's an example for our wallet. Real numbers from November 1st through the 2nd of November 2023. You're paying 2 coin flips, but you can only win 1 payout. IV's at 85%, so our options are stupid expensive. On November 1st, on 2 p.m., we're dovish. Data dependent, right? If we're data dependent, we're dovish. We want to be able to cut interest rates, and we're bullish, so the stock market loves that. So it popped 1.5%. On 4 p.m. market close, you're up. You hold overnight. Then Apple gaps up based off the earnings beat. Then wait, profit taking starts. Pullback continues, and then more selling pressure. You were right on the direction, but the whipsaws ate your game. So you probably should have just cleared it right here, fam, at open. Well, I don't know what you're waiting for. But let's keep going. The dangerous overlap. All right. So FOMC meeting, high risk because the Fed could say anything. Apple earnings, Apple could beat or miss earnings. And then the 24 hours are extreme, 2 binary events, right? Stacked on each other. So it could be good or bad. So the choices here is to trade the Fed outcome immediately. Risk is that the earnings is the next day could reverse everything. trade earnings, ignore the Fed. I probably wouldn't do that. Or sit out both, wait for the dust to settle. Missing the initial pop, but you avoid the whipsaw. All right, so the scorecard, if you traded live through both events before Fed got whipsawed, stress high, you needed 4%, maybe, fam, maybe, depending on when you got in. If you waited for both to clear, you entered on the 6, clean setup, stress is low, you would have netted 2%, maybe. The only difference is 2%, but way less stress for waiting. So the takeaway is when two big events are less than 3 days apart, we want to avoid it, right? We can't isolate the risk. You can't set proper stops, and you're not trading, you're gambling. What's the point? You might as well just go to Vegas, fam. So 1 day of separation equals we're going to sit out. The opportunity will come back. Your capital won't if you blow it. Say that again. The opportunity will come back, but your capital won't if you blow it, fam. All right, let's keep going. Why is the 1 day separation between the Fed and earnings so dangerous? Not enough time to analyze. Impossible to isolate which catalyst is driving the price. Options are going to be dumb expensive. So I would accept B or C. I would accept any one of these, but it is going to be B. All right, so what is a Fed pivot? A Fed pivot is when the Fed changes meeting schedules. That's funny. It's when the Fed changes from hiking to pausing or cutting, or is when the Fed chairman changes. Is when we cut, or is when we go from cutting to pause, or from pause to raising. So that's going to be a Fed pivot. So what is the main downside of waiting for both events to clear? You missed the initial move. Is it really a downside? Earning data may be leaked, or is it really? Kind of could be though. The Fed could reverse the direction. So one of the main downsides for both decisions is probably your little A. Beautiful. All right, so we have Microsoft. So we have one more after this. Then we're going to be chillaxing. We're gonna actually get real great understanding of this, right? So Microsoft triple threat week. Right, the terms we need to know is the FOMC meetings, a detailed notes from the Fed meetings released 3 weeks later. The catalyst is going to be the event that moves the stock. Either it's going to be earnings, the Fed, or CPI. Confluence is going to be multiple events happening close together. Risk reward is what you could lose versus what you could gain. So let's set the stage. Back in April of 24, the situation was that Microsoft was coming up. Microsoft earnings were coming up. Normally that was a clean slate, but this week had 3 events. We had CPI coming out on Monday. This is the inflation data. Earnings were on Wednesday, and then we had the Fed meeting was on Friday, what the Fed really thinks. Each one moved the stock together, pure chaos. So the question is any trade worth this complexity? Probably not. Your wallet, the complexity cost. With 3 events, you can't answer basic questions. What is the position signs? Too many unknowns. I don't know if CPI is going to come through hot. I don't know if it's going to be cool. I don't know if you're going to make it or miss it, right? I don't know if you're going to be hawkish or dovish. Stop loss. I don't know what to set it, right? Do I need to tighten the stop loss? Do I need a looser stop loss? What is my target? Target on all 3 of the events? Bro, you need to have, not even AI can help you. I'm not going to hold you. At some point, trading becomes gambling. So on Monday, hot CPI at 2.1, right? On Tuesday, Wednesday, the market was choppy. On Wednesday, after hours, the earnings were beat. So you see a little bit of a jump. On Thursday, open fade. And then on Friday was hawkish, so the market didn't like it. So you netted 7.2%. All that chaos just to net 1.5%. Was it worth the stress and risk? Hell no. On Monday, CPI came in hot, right? The market tanked on the inflation fear. On Wednesday, we could beat inflation, but CPI mood kills everything, right? Because it came in too hot. And then the Fed confirms the hawkish moves equals more selling, right? If things are going to be a lot more expensive in order for me to get into, I might as well just cut my losses and make my money, right? And go ahead and clear it. So that's why you're going to have more selling pressure or more bearish pressure there. So the choice is, are we going to trade through all the 3 events if we just got money to blow? This is expert level. Most people lose here, right? You need to be able to like really have a little crystal ball on CPI, then being able to trade the confluence of events. Just trade earnings. Ignore the micro. Still super risky because CPI came in too hot. The market didn't like that, so the market has to make back what it lost, plus being able to have earnings on top of that. I don't think so, fam. And FMOC affects everything. Set out the entire week. Boring, but boring saves your capital. If you don't have money, you can't trade again. Not every week is tradable. Not every day is tradable, right? This is one of those weeks, and that's okay. Don't force it, right? So final report card is that Microsoft beat earnings by 7.5% after hours, but after all the chaos, the stock was up 1.5% for the week, right? Because yes, CPI that came in hot. You had even after you beat earnings by 7%, right? The Fed still came in and said, and today was kind of a hot day. Like, so if you were trading Microsoft, Meta, or what was the other one? Microsoft, Meta, Facebook, and hold on, I'm gonna tell you right now. Microsoft, Facebook, and Tesla. Yeah, you probably want to sit this one out, fam. All right, where we are. Okay, beautiful. Yeah, sit out. So why did Microsoft only gain 3% despite beating earnings after 7% after hours? People sold that open. I wouldn't be mad at that. Hot CPI plus the upcoming FOMC created the market headwinds, right? And the earnings was revised down. That can happen, and you can also see the market react after that. So I won't be mad at A if you said that individual with that selling pressure being able to sell at open, but we are going to go with B. What are FOMC minutes? Real-time meeting minutes. Detailed notes released 3 weeks after the FOMC meeting. The Fed chairman's diary. Wouldn't be mad at that either. But we're gonna go with B. All right. So when is it okay to skip a trade? Never. Always trade. Probably you're going to. That's why you probably are losing. When risk reward is unclear or is too complex, I would agree with there. Only when you have no capital. That's probably walk away from you as well. All right, so this is where we are, right? We're able to go through all of our events and being able to understand FMOC, being able to understand the Fed, being able to understand earnings, right? I don't want to make this video too long. I think we are able to have a great understanding of where we are. If you haven't already, I need you to go ahead and like and subscribe. If you do have any questions, please go ahead and drop it in the comments. Other than that, it is your boy Kreative. We will be back at it again with another episode.